can send you even 100,000 USDC without KYC. It's just like a random wallet to a random wallet. That is like a massive achievement if it stays that way.
The grand adoption has not come from what we know as crypto.
The overall economy is in a bad spot. The dollar has been printed to levels that we can't even understand anymore. The US is trying everything it can to debase the dollar via stablecoins. The vast majority of growth for the US economy is just a couple of AI companies circle jerking the same $500 billion between them.
I do think there is sustainable and good sources of yield. That's not just, oh, we have a new type of vegetable governance token that's going to get farmed.
I also am reasonably confident that some of the larger traditional asset managers will enter the space and essentially act as a vault curator. GM, and welcome to this Christmas week edition of Odyssey. We are joined by Onur and Vlad from Tau Labs, who has been on the podcast, I think 2 times before. And
only once.
I think you were on the Roundtable
Actually,
after Stream collapsed too. And we did 1 episode on Tau. And today we will have our big 2025 review. So we'll discuss the winners and the losers of this year, which sectors performed well and which trends shape the market. How are you guys doing?
Pretty good. I'm known here. So yeah, welcome Vlad. Good to have you. Very excited to speak about some of the stuff with you. No, I'm doing very good. I'm pretty heads down planning next year stuff. So in that sense, excited for what's to come.
thanks for having me on a 3rd time, as you accurately mentioned, Max. Doing well, had a crazy good year. A lot of stuff changed, and we have big plans for next year as well at Tau. There is so much to talk to. Like a month in crypto feels like a year, and like a year in crypto feels like several cycles. So sure, we have a lot to go through.
Very nice. Do you guys think that there was any dominating theme for 2025? Like anything that really stood out?
I can take this one on notice first, or do you want to start? Definitely, and okay, I am subjective. I do run a vault curation firm, but vaults definitely, they did nothing but grow this year, and they're going to do nothing but grow in the following years, I think, as they become more sophisticated, more complex, and as curators, we compete with each other more and more, and as more protocols want to offer more primitive DeFi Legos for us to build upon. Prediction markets as well. I think especially with how close they are to the current administration, I think it's safe to say that they'll do nothing but grow for the next years. The only issue there would be the regulatory area, where are they going to be regulated as casinos or not? And outside of that, these are the 2 biggest things that I saw in the space in terms of winners by far. Are we doing losers yet, or are we doing just winners for now?
Just like whatever you saw dominating in terms of narratives.
I think these 2 have been by far the biggest. Yeah, in crypto at least.
What about you?
I second that, and I'm super excited about getting some more insights on all the vault stuff. But especially the rise of the prediction markets was fun. I find it also interesting what learnings we have with regards to the success of prediction markets may or may not doing anything on the underlying chains, which I think was a big surprise for me. But other than that, I think stablecoins is still a big topic, especially now with like more local stablecoins. So we have the big 2, but we're now seeing more and more initiatives where there's stablecoins as a service or stable coins for specific use cases or brands that I think we're seeing. So just anything in the regulatory stablecoin space, I think, is interesting as well. But I think, yeah, those are also the winners, I would say.
Yeah, I think this year really depended on which sector of crypto you were in. There was not one industry-wide narrative that dominated the timeline throughout the entire year. I think meme coins, they were mostly present in the beginning of the year, but they essentially died out throughout it, I would say. You still have a couple of them around, especially the old ones, but none of them have any mind share left. Nobody really cares about them anymore. I would say that by now, most people view them as a net negative to the space, whereas a year ago, many people were still riding the financial absurdism and financial nihilism train and kind of saw them as a valid alternative to the low float, high FTV VC tokens. But I think that like by now, whatever game we've been able to play in crypto, it has all pivoted so much to short-term extraction that the positive sentiment has essentially left the entire industry for all the industry internal games we've played. I think that on the public perception and fintech side of things, stablecoins were definitely the number one dominating narrative. If you were active on chain and like actively farming DeFi, I would say that the Hyperliquid Eco and Vaults are the two big ones here. Vaults obviously a little more on a meta level, and Hyperliquid as a narrative not only limited to the Hyper EVM and the Hyperliquid perp dex, but also all the other perp dexes like Lighter, Extended, Aster, etc. that have been coming after that. So I think that these were the leading ones.
There is one thing I wanted to touch on that is more of a general theme. There's this constant debate of are we still in the 4-year cycle logic or not? I am relatively firmly on the we're no longer in the 4-year cycle part of the camp, part of the debate. One of the reasons, and you basically said it, we've had cycles that have been dominated by retail, and they were been dominated by very aggressively extractive elements. So ICOs in 2017, NFTs in 2021, arguably meme coins this cycle. And it's very PvP. It's very zero sum. People generally either make a lot of money or like lose, and a lot more than not people lose a lot of money in these. And this can't, if like there are two ways that this industry can go. It can just stay kind of where it is, like with one foot in TradFi, with one foot in retail. But in that case, we'll constantly have hype cycles, maybe around meme coins or DAOs or whatever else there'll be in the future. But if we want this space to actually mature, and if we are to have Bitcoin be used even more legitimately as an asset, say for Ethereum, we'll have to have the industry be a bit more mature. And that fortunately or unfortunately means starting to function more like an actual business. More focus on revenue and less focus on extraction. Like look at the stock market generally. Okay, there are stocks that are a lot more volatile than Bitcoin has been these past years, and there are scams that are constantly, listed on the Nasdaq, on the S&P. I just recently watched a documentary about those guys that were saying they were replacing the LiDAR technology, like the lasers, and it was LiDAR, and the IPO just tanked. The tech just wasn't there. So this will always be a thing in the industry. There will always be, scam industries or scam companies. But there has to be a point, there has to be an inflection point that it can either be now or it can be later. I don't know if we're there yet. I think we are. Where the zoomed out chart of Bitcoin and Ethereum will start looking more like a line slowly inching up. All-time highs will feel less and less exciting because we'll go to like 130, yay. And then 132K in a couple months, and then a year later, 140. And that is a sign, for me at least, that a lot of big institutions are, scaling in, or TWAPing into their positions, etc. And I think this will be the fuel for the space for the foreseeable future. We can't really get to being where a lot of the OG crypto cypherpunks want the space to be if we'll just rely on hyper extractive NFTs and meme coins and stuff. Let the meme coin people of this cycle go to AI and do startups there, and then come back to crypto when it's big, and then they go to something else. So that was my 2 cents on what you said earlier, that we might just be out of that. And I would much rather build like legit stuff in this space than have VC hype cycles pumping money into NFTs and other stuff.
Did you guys see any surprising winner of the cycle, like something that you didn't expect at the beginning of the year at all?
Yeah, for me it was prop AMMs. What was not on my radar at all, and they are killing it on Solana right now, especially Humidify, the main one.
Can you give a TLDR of what they are and roughly how they work?
It's essentially not an open DEX like Uniswap where anyone can LP, but it's basically a closed market making operation, which still is connected to the DEX world. So that they're running their own market making. They can offer much tighter spreads. The way they, I mean, I can dive into technically, but I think they're basically posting prices on all the Sol pairs every single second or block, which is why they're spending a lot of money. I think like you can even look at what percentage of the Solana blocks is just like Humidify posting prices right now. But essentially, they're offering much tighter spreads. They don't have a front end. It's just like all the traffic is routed through it via the wallets or Jupiter or some aggregators. And they're making, let me check, like they have a couple billion in volume, which is insane. But I need to check how much volume they have exactly. But they are, for me, one of the winners of this cycle that I didn't expect.
Yeah, I think a general theme of the cycle is that most of the very few winners, and I would say that contrary, most of the sectors, narratives, applications have been losers in this year, and also investors. Most of the few winners, they were not really opportunities for everybody to participate in. I think one of the very few exceptions there is the hyperliquid eco, but obviously that already started end of last year. And I mean, in prediction markets, you can capture the upside, but obviously you don't own any equity of Polymarket, Caltri, or any of these associated ones. Similarly with stablecoins, I'll pull up that report later, but the DeFi Llama 2025 report, when it was talking about the revenues generated on the application side of crypto, I think Tether and Circle, they combined make up around, I think, 60 or 70% of all application revenue generated in crypto. And like that is something where the average investor into the industry has zero access to. And when I saw that statistic, I was surprised, or like it made me think in two ways. I mean, the one way is that the things that actually make money are not as accessible as we pretend that they are. Even though we can permissionlessly use the technology, most of the value is still created in and also captured in a centralized manner, not in a decentralized manner. And if you think about it, Tether and Circle are probably the least exciting business model in all of crypto. Like they literally do not do anything other than custodying stablecoins. That's all they do, and they make most of the money. I mean, the report obviously didn't go into centralized exchanges because that is nothing that they can track on chain. Maybe that's like another sector where a lot of profits are being made, but still, like the most boring sector making a lot of money. And frankly, the whole centralized stablecoin sector, it should be much more of like a dilutive margin game. Why are people still able to just use Tether and Circle and like pass on all of the revenue? Why is there nobody with a US-based stablecoin who passes on, let's say, 70 or 80% of the revenue to the holder?
I mean, so touch on some of these things. I had this conversation Sunday with a good friend. So I'm going to answer your question first, and then I'll take a step back and back to the prop AMM stuff. I want to follow up with some stuff. I think like if you think about it, one thing we are overlooking, in my opinion, is think about how far we've came that we can send USD-backed stablecoins without KYC. That's insane. That doesn't exist in fiat land. Like a fiat to fiat transaction is unthinkable when it's not KYC'd, right? And we shoved it down their throat so much that I can send you even 100,000 USDC without KYC. It's just like a random wallet to a random wallet. That is like a massive achievement if it stays that way. There are other jurisdictions where if you were to do a stablecoin, it wouldn't be possible. We looked into Switzerland, for example. The financial market regulator, FINMA, does not allow it. So I think, that value proposition alone to me is good enough to not having to have exposure to the yield necessarily, especially because in crypto there's like other venues which still expose me to yield. I still don't disagree with your thesis. I think there's room for a player which also relays some of the native yield from T-bills or treasuries.
Yeah. Just wanted to add on that, Max. You said initially the most boring business model makes the most money. I met a guy a couple of years back. He owned a private jet company, and I talked to him about his business. And he said, and I asked him at one point something along the lines of, so like your most expensive customers, like your richest customers, I imagine they're like football players and influencers. And he said, no, yeah, they're usually the ones that rent. But the guys that actually own the jets and the guys that actually own flotillas of private jets, they have achieved some of the most boring business models in their field imaginable. Like one guy just did he found a better way to do software for automated grain collection from those big tractors. He just improved the collection by, I don't know, some percentage, right? And that made him like almost a billionaire. And some other guy found a way to do something with bonds that nobody looked at. Very boring, very chill. Multi-hundred million net worth. It's very often the simplest business model are the ones that work. You don't have to overcomplicate things.
I think in the real world, that is much more applicable because the boring businesses in the real world, construction, garbage, whatever, they actually do something.
Yeah, because
Tether and Circle just hold US dollars.
Yeah. I mean, they
The
are a bridge.
fact even is a business is kind of absurd.
Yeah, they are a bridge in between a TradFi world where there's a lot of money, and to do any form of yield, you need 180 licenses, and you need to have. Do you remember the scene on The Big Short when they go in when the two guys with the fund they go on into J.P. Morgan's building to get that ISDA license so they can short the housing market, and they tell them you have to manage at least 1.5 billion. It's the same thing. It bridges between that world, which is full of regulatory onsets. Not that regulation is bad, but it's too much. It's already super mature. A lot of the big banks and the big hedge funds are super competitive. It's very hard to make a name for yourself there. And they bridge it into the money Lego land, where if you're smart enough and take enough risks to do like weird strategies or weird stable coins, if it works for a while, the market says thank you and comes and joins. So that is a use case that I would argue against your thesis that they just hold dollar. Yeah, they do, but it's for a reason. As for the yield, well, there are many stablecoins that are trying to find sources of yield, whether it's RWA or directly on chain, and to pass it on. The goal of these stablecoins like Athena and others when they do points, and we work with a couple of these, and we also design their incentives. The point isn't to keep the Ponzinomics going forever. The point is to incentivize people early enough to come and join, so that you grow to a market share and you grow to a TVL, to an actual deposit organically as much as you can. So big that you basically it's much harder for you to fall after, and you are implemented into so many other protocols and other chains that you will always be a part there. And then you start making fees from and then you start making more money from fees. Resolve is a good example. Like they are diversifying. They don't care about TVL as much as they did before. Of course, they still want to grow it, but they're looking at diverse ways to diversify their yield, diversify their senior tranche, their junior tranche. So there are different experiments happening in different ways that stablecoin projects are trying to incentivize people to come. But over the long term, as the industry grows, I think there will just be more and more stablecoins, yield-bearing ones. I think we'll start to see mergers between them at some point. Yeah.
Yeah, I definitely second all of that. And I also disagree with you, Max, because like for certain jurisdictions in the world, having exposure to safe dollars, I think like un-KYC'd safe dollars is insane. It's insane. Like I think people don't care necessarily about the 3 to 5% T-bill yield. Especially since you have two major players, right? You have Coinbase, who's basically the US government, like it's as close as it gets, and try to do something regulated in the States. Like everything points at Coinbase or goes through Coinbase. So you can't. Sorry?
You mean Coinbase or Circle?
I mean, mainly Coinbase, but like Circle, Coinbase are doing USDC. And then on the other hand, you have Tether, which has been around the longest. It's just like the like it never dies. Like it was flooded 500 times. It never dies. It's still around. And I think the longer something is around, the more kind of like credibility and confidence it gives its investors. So again, taking into account you have one of the most regulated and one of the most resilient stablecoins, which represent the US dollar, having exposure to un-KYC US dollar globally 24/7, to me is value proposition enough to not be considered doing nothing.
Huge value proposition, and I'm not questioning that value proposition at all. What I am questioning is that nobody has tried to attack the margin that both, I mean, particularly Tether have. I mean, Circle has like okay-ish margins because they pay a lot to distribution partners like Coinbase for them to get more USDC into circulation.
Yeah. Speaking to the access to on KYC USDC, I dated somebody from Africa for over a year, and whenever I wanted to send her money for like a small amount to help with something, the fees were insane via Western Union. I spent quite a bit of time in Africa as well. I come from the European Union and I'm from Romania. You don't feel it when you go to Germany or Spain. You use whatever money is there. The Forex fees on apps like Revolut or N26 are insignificant. It's basically like you're in the same country, just people talk funny and there are different flags on buildings. But the rest of the world, especially Africa, is not the same. Like you cannot take money in and out of one country. And it's very hard to exchange from dollars or from euros into it. And a lot of people there are actually looking to Bitcoin and crypto in general and stable coins as well. The possibility to move dollars into stable coins and then somehow either OTC them or something else back home instead of paying, $50 fees on a $100 transfer or something was also good probability. Was also good value proposition. One issue with that is that a lot of people have tried it and there isn't really any big project that has moved towards it. There's this fintech company that I followed back when I worked in payments as an analyst called M-Pesa, Kenyan based. At one point, they were like 54% of Kenyan GDP. It's insane. Just a fintech company, a fintech bank, and they just managed to unify a lot of, to be like basically the Revolut of that country. And I'm sure there will be a project that will be able to unify and to change Forex within Africa, within South America, or whatever, via stable coins. It's hard to do when there are problems with liquidity and other stuff, but this also is an important value prop because those markets are completely locked off from the rest of the world. We have it very good in what we call the West: Japan, Australia, Korea, Europe, North America. But the rest of the world does not work like that at all. Actually, money is very, very fractured.
On the note of the decentralized stables that you mentioned earlier before we discussed the Tether and Circle, I think these were also one of the winning sectors this year. Most of them have not been that long lasting. I mean, even Ethena, as sort of a behemoth among them, has kind of collapsed in TVL over the past couple of months. But I would say that the likes of Reservoir, Resolve, and like all these basis trade or lockups combined with basis trade like neutral, etc. I mean, you cannot even keep track of all of them anymore. And I would say that overall, this was one of the few sectors, particularly present in DeFi, that at least created a little bit of value, even if not always very sustainable, pretty much out of nothing. So yeah, I would count these towards the winners. I would say that curators like you are also on the winning side this year. Of course, yeah, some of us. I mean, especially over the past 2 months, ever since the stream collapse, obviously the sentiment around vaults and curation has dropped a little bit. But I think overall, everybody now recognizes curation and vaults as like a serious part of Ethereum DeFi. Large traditional asset managers are getting more interested in it. And I would say that it is, let's say, the aggregation of users and allocators that really drive a lot of volume and also a lot of TVL in Ethereum. And I would personally say that this is likely going to grow over the next couple of years, but you probably have a lot more granular insight into that.
I do, but I want to hear Onor's take on Vault Curators first because I had my little stablecoin payment rant before.
I've been bullish on vaults since Yearn, and I never understood why they lost so much mindshare, to be honest with you. I'm following Bantag. I was like huge follower of Yearn. I think vaults are more complex in a more complex cross-chain world, but I see a ton of opportunity there. So I'm very bullish vaults.
I haven't interacted with Yearn for forever. Did they ever evolve beyond like just like compounding token incentives?
I honestly wouldn't know. I haven't checked them in a
Same.
while, and I live and breathe in this space. So it goes to your argument of there's too much happening. I know they've done a push towards vaults, but yeah, this is probably a good transition into the what you wanted to hear from Young Curation space. It changed a lot, but it stayed kind of the same at the same point. I said this previously, I think, on your podcast. So I'll just do a short version of it. At the beginning of the year, and like the pre-stream vault curation era was simple. There were 4 big curators: Gauntlet, Steakhouse, RE7, and Mev. And then there were kind of the rest of us, little mice, running around picking cheese crumbs from the floor.
What do the current like rough AUM numbers look like between these bigger ones and then the smaller ones?
Steakhouse and Gauntlet, I know they're above $1 billion, both of them. And then you have a couple $100 million from the rest. We've had the TBL discussion previously, and I'm not accusing anybody. We recently listed on DeFi Llama, and we decided to only list with our deposits, which are like 10 million. Whereas if we did our TVL, which is rehypothecated capital, and some double counting we have from some vaults that lent to each other, it would have been over 60. So we made this decision not to. But I swear it's like one distance away. You just have a different smart contract that reads all of your vaults together, their notional value, and then you feed that to the common. So I don't know. Like, look, the actual number, I don't know. And this is based on just my gut feeling. Take the total curator TVL, cut it in half, and remove another 10%. And I think it's kind of around there. But this is just purely based on my estimation. Steakhouse and Gauntlet, I know at least 70% of their TVO is actually there because it's lending optimization. So at least that is definitely there. And the rest, I think, is also a good chunk of it. They also benefited a lot from the blow up. But it changed quite fast. And one more thing that is happening now is that there are a lot of devs in this space. So whenever an opportunity happens, the Pavlovian reflex is let's build infra for it. So there is a lot of vault infrastructure that came up this year. Vault infra that is cross-chain vaults, vault infra on Monad, vault infra on some other chains. But there weren't that many vault curators because it's actually not easy being a vault curator. And now we're starting to see more vault curators actually appearing because there's too much infrastructure, and too much infrastructure is fighting to, like, you grow, you have your money, then you want to get Gauntlet, Steakhouse, Tau, Hakutora, whoever, to come. And we all say the same thing. My man, I'm curating on 3-4 tech stacks. My devs, the ones of us that do our own automation, our devs already know 3 to 4 tech stacks. We're on 5 chains already. I do not want to learn a new one. I do not want to spend another month or two learning a new tech stack, deploying a new vault, with changing either my bot or having you do upgrades so that I can do my own automations there. And a lot of people started to realize this, that you can't just build infra and have like one place and have like a million vault infrastructure platforms. Some curators are building their own, like you have these pairs with like Upshift and August Digital are basically almost the same team. Machina and Dialectic. And yeah, it works for their own thing, but they have the same problem. Like, you grow, you manage your own TVL, but then you have to encourage somebody to come over.
No.
And you do that through points.
And I wouldn't even say that there's a lack of people willing to be a vault curator. I would say that by now there is a lack of interesting opportunities to spin up vaults around. Like, you need to have interesting yield opportunities to even like succeed as a vault curator.
There is another blocker there. The reason why Gauntlet and Steakhouse do most of their money through lending optimization is that they have a lot of money, and that is low risk. And in the end, they don't need to necessarily deploy into more exotic strats. And then you go down the line, you see the newer curators. And this was our bet when we started doing curation. We started doing loops when they weren't that popular. And then we looked into other stuff, carry trades, Pendle bond ETFs, etc. So we're always looking for like interesting strats and new ways. We always like to be first to try something, to beta test the environment, basically. But and this isn't widely known in this space. It always shocks me when I talk to people. Very few curators have devs in house that can actually do the automation, because building a bot that executes a strategy, maintains a certain LTV, rebalances by itself, it's a lot of work. And you have to have your own data cluster like we do and run it. And a lot of curators do their strategies manually. That's why they only have like 3 or 4 strats up at once. It's a bit the exception because we've done so many already that it's much easier for us to deploy vaults. So it's not just people don't have ideas and there's nothing to do. There are that many people who can actually execute on it. The Bitcoin and the ETH carry trade strategies we have, that rebalances on leg one between the debt, between the deposit assets of Bitcoin or ETH and USDC. And then the second leg is an infinify loop that we run. And not only does it have to keep the balance and the reallocation and maintaining the LTV target that we set programmatically on the second leg, it has to constantly rebalance on the first one and always move capital if it needs to pay debt and avoid liquidation. And this is even without going into edge cases. So the actual reality of building, doing this is actual quant hedge fund stuff. Not a lot of people have the capital, the resources, or the know-how to do it. And it takes time. It took us a year of 8 months of building these from scratch. And there were a lot of weekends worked where we said we're going to launch this next Thursday. We still have to test this element of it and this part of it. But that's the real blocker, I think. And that's why we decided to go for one with like dev work. There are a lot of stuff to do. There's a lot of stuff to do even now. People want to do a yield on gold. There's a lot of Forex stuff that you can do through stablecoins, which is super interesting between the euro and the dollar. You can still do stuff. There are so many possible combinations. You just got to compete. So that's my take on it to oppose yours.
Are there any particular trends in the curator space that have been standing out maybe over the last couple of months, and how do you see them evolve and going forward into the new year?
Onur, do you want to take this? I don't want to be the only one talking.
I think for vaults.
Please continue. Exactly. I fully agree.
Definitely permissionlessness. Again, this is a shill. I'm sorry you had me on. Our vaults have never been anything other than permissionless. Every dollar we've ever moved, you can track on chain. No shenanigans, no X% of it is actually on a centralized exchange with an API key that only we have. No, none of that. So I see a lot of the curators moving in that direction. There are a lot of initiatives. I'm sorry?
Finance? No next stream?
If it will be, it's not going to be through us. At least not while I lead Tau, that's for sure. If we ever do permissioned vaults, we'll get licensed as a hedge fund somewhere and we'll have a KYC element in some part, and we'll sign contracts with people that want to give us money, and we tell them, okay, it's our fiduciary obligation to you. But that'll be a separate, they'll be within Tau, but it'll be a separate permissioned entity, not the permissionless one. The second one is risk management. We have been invited into a bunch of initiatives, and we joined a couple to try and work towards a risk standard, something similar to Basel. We're working on this with Keyring and with Laser Digital quite a bit on an initiative. We're trying to bring others in just to have a risk standard for the industry, or to at least like lead in part. It's hard to build these things because usually people are they care a lot about their brand, and there are a lot of egos in this space, not just in DeFi, just in crypto in general, in finance in general. So I hope some stuff will come out of these things. Definitely, it's going to become there's going to be more quant risk methodology. You would be surprised, I'm not going to name any names, you'd be surprised how allocation decisions were made by big curators that we always looked up to, like, oh my God, those guys, one day maybe we'll be like them. And then we saw a bit under the hood, and allocations were basically YOLO. So risk management, permissionlessness, these two are by far the biggest. And I think a third one, and this is just my feeling, I think people will be more open to trying more and more like exotic strats. Like Reservoir did the first carry trades that we took inspiration from to make our own. It worked great. They're doing a great job with them. I like what the llamas are doing with their own vaults on IPOR and what they're going to do with them in their own ecosystem. And these kind of like actually do money Legos, not just blending optimization and loops. There's a lot of stuff that you can do, and I think the next year, regardless of where Bitcoin price is going to be, we're going to see more and more interesting strats. And we sure as hell have couple of strats that we're going to launch at the beginning of in Q1 and Q2 that I can't wait to have out.
I fully agree that vaults are likely going to be one of the leading themes in DeFi going forward. And I also am reasonably confident that some of the larger traditional asset managers will enter the space and essentially act as a vault curator. What I'm still a little more concerned of is that we still haven't fixed the sort of long lastingness. I know you don't like the word sustainability for yields, but like all the yield opportunities that are out there, at least the ones that are quickly enticing people to move capital around, that the ones that create FOMO, they're still mostly subsidized by points, and all of these points program will come to an end one way or another. And especially over the last couple of months, most of these points programs have been disproportionately disappointing. Like we have not been able by any means to replicate the success and the euphoria created by 2024 airdrops and 2024 point seasons. Like Ethena season 1 was 2024. All the restaking eigenlayer and EtherFi and the associated ones, that was all in 2024. Hyperliquid was in 2024. It is yet to be seen what Hyperliquid season 2 will yield, but I think the sentiment, the expectation is also like any type of quantitative observation you could have made by looking at TGEs resulting from points programs this year. It has been disappointing to put it mildly. So unless we fix that, or we are able to bring new sources of yield on chain, like the whole curation ecosystem will be capped in its growth and in its interest just because there is going to be a lot of difficulty attracting new capital on chain and like to find new opportunities. And like I wouldn't underestimate that. So I think we should be very wary to not follow down a similar approach as many of the layer ones did and many of the infra projects did in 2021 and 22, where it was said, well, if you build it, they will come. I mean, there are countless projects where this didn't play out at all. And like, I'm not saying that for DeFi and for vaults, this will happen, because obviously it is much higher in the stack of like infra and underlying tech to applications. But like there is a risk of not paying too much attention to where the yield is actually coming from. But maybe let's...
I
Sure.
would love to comment on this since I was asked earlier. Here I'm more opinionated. So I obviously don't think any of these like airdrops or point system considerations are rather sustainable. However, there's very sustainable on-chain yield. And I'll just give you like two simple examples. One is trading fees as an LP. You just get like 25 bips or whatever on each trade that you provide liquidity for. And the other thing is in money markets, like you have origination fees. Yeah, exactly. So I do think there is sustainable and good sources of yield that's not just, oh, we have a new type of vegetable governance token that's going to get farmed. And also the other bigger thing I wanted to say is like, I had the chance to speak to some of the Solana Foundation at Breakpoint this year. And, you know, they're talking to the institutions that are looking to deploy 8, 9, or 10 figures on chain. And they are looking into deploying 8, 9, or 10 figures on chain. It's a reality that is being explored. And that's why I think on-chain will 1000x from here. So I do think vaults will play a big role. And I think it's completely normal that institutions take a conservative stance and it's going to take forever. Maybe it takes another 10 years. I don't know. But I'm more bullish on yield sources than I was during DeFi summer, because DeFi summer was the most unsustainable thing ever, in my opinion.
Well, no, we should talk more. It was literally the same points I wanted to make, like to a T.
I mean, I'm not wanting to refute that there are base yield sources into DeFi, like lending or trading fees, but like the capital that can be served by these yields is already being served. Like the capital that is flocking around, the capital that is looking for the new exciting thing, that entire part is subsidized by short-term speculative points yields.
No, let's go back to boring.
Yeah.
Let's go back to boring.
Can I?
Because
yeah. I'm sorry, I'm going to go ahead.
Just one thing. So if you want to deploy 50 million Today, I would argue it's very difficult on chain. You still go through Binance or some large OTC desk because you get better execution there. So I think there's still a lot of room for boring capital on chain in order to surface and serve the bigger checks that we're trying to bring on chain. So I do think there's still room. Just to your point, but Vlad, you had some more points.
We work with a couple of our LPs. Some of them joined relatively recently, and some of them are quite big in the space. And we talk about this a lot. Max, not every yield has to be super exciting. And what any fund, any private equity firm, any hedge fund wants to do is in their vertical, see what the average yield on an asset is, and try and get that average yield plus X%. If the average yield is 4% and you manage to give people 5 for a while, awesome. You have an edge, people will give you money. If the average yield is 12% on a stable coin, you manage to give 15, awesome. People will give you money as long as there won't be some other guy giving 17 or 18, right? The space just needs to keep growing. There are constantly new funds, like every week, including now when I should be with my family, honestly. I'm constantly talking to either off-chain businesses that have massive treasuries and want to bring them on-chain to be curated by us, or I'm talking to funds that want to allocate 5, 10, 15% of their AUM to come on-chain. Their interest is absolutely there. They don't really care about the Bitcoin price. I never have these discussions with the RWA projects over at funds. They couldn't care less. They care about stablecoin yield. They are interested for how to accumulate more Bitcoin and ETH, but they don't really care about the price that much, and they don't really care about incentives. A lot of them, I think, all but one of our institutional LPs discount points to zero. Like, they tell us whenever we negotiate performance fees, they said, you guys can keep the fees because we can't put them on our book because we can't account for them, regulated.
What are these entities looking for in DeFi? Because if you look at lending, like the really safe and the really boring lending opportunities where you can enter into with size, they do not yield a ton more than like some money market funds or private credit funds or whatever you can do in traditional finance.
And that is enough. Some of them have treasuries on chain. Some of them have, I don't know, $10 million of USDC standing around not doing anything.
Why would they take the additional tail risks of DeFi upon them if they're not even expecting a significantly higher yield than what they can get in TradFi?
Well, this depends when. Lending optimization. I mean, lending rates after stream, they were great for a while. I mean, our LO averaged to 6 or 7 for like a month, which is crazy. Now it's about like under 5, I think. But if lending optimization is low, it means there are other opportunities like loops that are higher. If money is cheap to borrow, you can use leverage a lot more. So they are looking to hedge on a lot of these. They're looking to have part capital in lending optimization and then hedge it with either some off-chain options or some loops or some other stuff. The way big funds are approaching DeFi is very different from the DeFi retail. I always defend DeFi retail because people, especially people like in the dojo, like you, like us, we know how the space moves, and like they're legitimately super intelligent people with some of them quite a lot of capital, quite big whales. But funds approach it much more of a structural thing. Like they want to be in DeFi and they want to, like, you can have high borrow rates so that lending is very good and at the same time have very good yield from loops, for example, because they work opposite to each other. So when they allocate, they always ask us how to allocate sort of in several things. And then they do risk based on that basket and stuff. So they're fine with having one or two strategies be, basically T-bill plus 1% for a while, as long as they earn yield in other places. They have KPI targets for their yields. They're very reasonable often. The bigger the fund, the more reasonable they are because the same as I said before, they manage more money, they don't need risk. And this constant stream of money is coming. Every time we talk to a big fund, it takes many, many months for them to start allocating in. And it's not just us, it's the same with Steakhouse, it's the same with Gauntlet. Institutional players move slow and they care about consistency a lot more than stability. If I bring 50 million into DeFi over the next year or 100 million, what does it look like? Where can we allocate it to? What can we do outside of points? They're very well aware of protocols that only make yield from points. And we always work together, and we always do risk too. And we point them at the exact same thing, as Ono said. Borrow rates. So one of the oldest financial instrument in history has been lending money. And that will never go away. Same for swap fees. And we start from there, basically. So from what I see, there is a lot of off-chain money that is coming in. It just takes time. It's slow. 10 million here, 30 million there, another 6 months, another 50. And that's how you move. That's how you grow this. The bigger the pie, the less it will matter to do all of these Ponzi-nomics to give 20% on stable coins for a year. So in the boring stuff, I'm very bullish on it, and I want it to keep growing. And we'll sure be here for, like the entire way ahead. I feel like Oro and me are on one side, and we just pushed on this together.
I hope you are right with that. Like, I'll happily witness DeFi get more boring if that reduces any types of like existential risks and us worrying that our industry might not be here in 5 years anymore. So I think
I've been in crypto. I've been in crypto since 2015. The amount of times I heard that crypto will die in 5 years, man, it's not going anywhere at this point. And
have you read that crypto is dead thesis? But I think
yes, and it's a great article, and I agree with a lot of it. And the core of the argument is the same, that it's changing, and the extractive NFT ICO part might have gone away, and it's just going to be another boring TradFi vertical. Which, if we want it to become mature, that's what it'll have to be at one point.
Well, Vlad, we joined around the same time, and that's nice.
Yeah,
that article is something. I think that article did a very good job articulating something that many people were thinking but weren't really able to articulate as good. But for example, one thing that never made sense to me is like a crypto Uber or a crypto Airbnb or anything like that, right? Like, why in isolation? We're building certain primitives, and if they are better, if they're superior, they will get adopted. And if they aren't, then they won't. It's as simple as that. And I think the boring stuff like payment, like money is the killer app. Payment is, we take it for granted, like you said, in Europe or in the Western world. I think in many places it's still a killer app. The other thing to me is like just like pricing things, being able to create markets and price everything 24/7 is like, I don't need more. I don't need this technology to do more. But yeah, interesting.
Maybe to move on to the losers of this year, which categories, applications, themes would you put into that bucket?
So I can maybe start. There are certain ecosystems, including the one I've been working in the most, that I think try to keep up a narrative which never existed. So I think some of these ecosystems are, I would proclaim, dead. This is like Cosmos. I would say the same about like Polkadot and other ecosystems that are trying to create something that doesn't really, there's no real need for, there's no real users, and there's no real capital. So it's the worst of all worlds. I would also say that, we came to a point where everyone wanted to work with influencers or KOLs, but I think KOLs are probably the losers of the cycle, because everyone just realized, like some of the most extractive, short-term thinking, toxic things that happened to the space in this form, I would say, in the last couple of years. You always have had opinion leaders on Bitcoin Talk Forum or on Twitter, but they were all like very cyberpunk OG people who really believed in some stuff, right? And then we had this cycle, which were weird people, to be honest with you, that only focus on extraction. I think extraction is the theme that is kind of the loser here. Honestly, like I would go as far as saying everything that we didn't discuss as a winner, it's probably a loser.
Yeah, I share that sentiment. I think most investors, most applications, most chains, most everything in crypto this year has been a loser. The grand adoption has not come from what we know as crypto. It has come from stablecoins, which are centralized companies. It has come from centralized exchanges, which are centralized companies. And it has come from fintech players who are like dabbling a little bit on chain, but we value accrual. And I mean, rightfully so. I mean, it would be kind of a sign of weakness on their side if they were integrating our tech, but they were unable to capture the value, and all the value would flow through our DeFi tokens and whatnot. I think on the note of ecosystems, I would say that Cosmos has already been dead in 2024. It's just more dead now. Nothing really has changed between a year ago and now, just that by now even less people care. There was no significant collapse, no significant sunsetting or whatever. It's just like it's bleeding out until like the dead corpse is completely disintegrated. I think Polkadot has probably been dead since mid 2023. Cardano, I don't know. I mean, still pretty high market cap, I guess, but there hasn't really been anything going on since, I would say, 3.5 years. I think they aim to like launch transactions or DeFi on Cardano in like late 2021 or like early 2022, but I think ever since pretty much nothing has happened. Similar fate to all the old L1s of last cycle. Avalanche, it's still around, but there's not really anything exciting on there. I think out of all the old layer ones, Avalanche is probably the one that is still most alive. Like there are still people doing stuff on it, but there's no growth trajectory, at least not from what I can see. Sonic is completely dead, and also kind of the successor of Sonic, mimetically, which I would put Berra into that bucket, Berra Chain, that also died. I think that like Berra Chain tried to become what Sonic never managed to, because essentially both of them followed that very similar narrative. Okay, we are going to be the chain focused on the DeFi degens, and Berra Chain, like from day one after launch, it's pretty much been a down-only roller coaster. I think among the TGEs of 2025, I saw a spreadsheet making its rounds on crypto Twitter where it mapped all the returns ever since TGE from whatever got launched in 2025. And Berra Chain, even if it was one of the most like heavily backed and highly valued projects, it's down among the most.
I found that sheet, but I can't share. Can I share it with you and you share it, Max?
Yeah.
That's super interesting, actually. You know, this is. I saw something similar with regards to everything that lists on Binance. Like 95% of the assets or 98% that list on Binance go down only afterwards. And if you are retail in the space, I think retail is actually the biggest loser. Like if you're not an insider or you're not you don't have access to privileged information or assets, you're the loser here. Because I mean, you tell me what did well. Maybe hype airdrop if you've done something there, but I think most of the
But
assets.
that was already last year. I mean,
yeah,
meme coins were last year as well, unless you were an insider and could extract into 2025, you completely lost out. I would say that meme coins are probably like the single biggest isolated loser of this year, of what we know as crypto itself.
Thank God. Although, can you share that with me? And I've never seen it, and I like seeing
Sure.
too much red and minus 93%.
I'll send it over. I would even say that most of our beloved DeFi coins have been among the losers of this year.
Yeah, we spent a lot of time thinking about this. As some of you guys might know, DAO started off as a tokenomics agency, and then we slowly evolved into a vault curation company. We still do tokenomics; it's just integrated into risk management, and we took everything we've learned from there. But yeah, it's very hard to find an actual mechanism that keeps all of the money from coming in, and how to turn mercenary capital into sticky capital. People will go to the next big thing, and the goal was always to try and keep as many of them as you can. I basically said this earlier with points. If you grow to 100 million TVL and then you do your points, your target shouldn't be to keep 100 million TVL after TGE, because people will go, and as they should, if they want to try something else. But it's to try and keep at least 50, if not 50, at least 40, if not 40, at least 30, and then grow from there through partnerships, through attracting protocols and stuff. That is arguably like the best way you can do, and it's not very different. It's not very different in TradFi, to be completely honest. It's just these cycles in TradFi are much slower. That's the only difference. Crypto is very fast and it's very catatonic. It moves a lot. It moves a lot faster. So I think that's why we see this a lot more in crypto, like mercenary liquidity. Yeah, look, already Fivers, My Network, Humidify, we talked about. Aster.
Yeah. Funnily enough, Aster is the highest.
Yeah.
Multiple up. Yeah, how do you see the path going forward for DeFi coins? And let's not talk about the like super dilutive token incentive tokens, but the more serious ones, which are kind of DeFi behemoths. Let's take Aave, Uniswap, and maybe some of our challengers like Aerodrome, Morpho, then the likes of Ifina and Pendle. Do you see any positive outlook for them, or is it basically dead until they have fixed the alignment between token holders and equity rights to the underlying labs entities?
Oh, this is for me or for Onur?
For you. But only you can also answer, of course.
Basically the same answer as before, to be honest. It depends on the project and it depends on what they do with the token. There are very few cases where a token is actually needed, where you can actually use it as a tool to, quantify and monetize loyalty and engagement, like stake your token in order to get the revenue share. That, for example, is a pretty good, that is a pretty good mechanism. Of course, it can be done in a lot of poor ways, but I think ultimately it's a race to zero for the vast majority of them. I think they will slowly move. Like in the case of Pendle, for example, with their VE, and generally VE tokens, I think they're pretty. I'm a pretty big fan. Of course, there are many issues with it, but I think VE type tokens will still be around for quite a while, because again, you trade time and profit for risk, right? There are people that want their yield now, but there are a lot of people who want higher yield later, and they're willing to take the risk. And in this case, a token is actually a pretty good tool. But outside of that, unless you have ungodly amounts of stable coins in your treasury, like Hyperliquid does, where you can just buy back a significant portion of your token on the market, don't really see that much utility.
Do you personally hold any DeFi coins if you're willing to share that?
Right now, I think outside of Pendle, no, I have a lot of stable coins, Bitcoin and ETH.
Yeah, Pendle, I really like Pendle. I want to hold this thing, even though the price action has been absolute cancer for the past 18 months. Like, the product is great. Arguably, at least for 2024, I think it was the best like rising product in all of DeFi, along with Ifina.
Oh yeah. I agree.
So was the initial question about tokens? Sorry, Max, could you repeat that, please?
Yeah, do you see any positive outlook for DeFi tokens, given that they are among the losers for this year continually? Even though that, I mean, in comparison, in their price action to other tokens, they don't really look like a big loser. But if you put it in contrast to the growing adoption of their protocols, but the price underperformance, they look like a pretty big loser.
Yeah. So I'm very opinionated on this topic. And I think, to be as clear as possible, if you are bullish DeFi tokens, I think you get sufficient amount of exposure by just buying the most important one or two. One I find quite compelling right now, obviously not financial advice or anything, is Aave, for example. I think, Aave has been hurting more than it should have, and it's, core DeFi, it's doing very well. I'm not necessarily bullish on the longer tail DeFi assets, especially if it's still somewhere along the lines of governance or so. However, generally speaking, my thesis evolved a little bit for crypto. So, this thesis like read, write, own. And, own puts a lot of emphasis on obviously the ownership part, which we represent most often than not through tokens. But what is it?
Ownership or the ownership?
The ownership. Nice to meet you, Max. My name. No, but like, you know, own is just what? Like, what does own mean? I think own represents a state, and in my mind, it should be read, write, and something like price. Like, we've created something now with on top of the internet that allows us to price anything 24/7, whether it's an asset, whether it's attention, whether it's like, you know, something untangible or tangible, I don't care. So, and when you put price into center of the technology that we've created, it can be a token. Like, a token is a great tool to price something and to create supply and demand, but it's not the only tool. Speaking of what we had before, like prediction markets, maybe we leverage prediction markets more to price certain pieces of information that we believe will hold true in the futures. I got slightly more bearish token in general. Token will never go away. I think token are an essential part. But I think, like, to come to the first point, even if you're bullish tokens, you'll probably do better or good enough just doing the boring thing again and just like buying the main one or the main one or two.
Any other major winners or losers you guys would highlight?
Now, there have been, from the stream blowout, Stream and Elixir obviously big losers because they blew up. Some other big curators that were allocated their lot some of them took a very big hit, like MEP Capital, RE7 as well. Telos Concilium, I think, as well had like a lot in Elixir. So these guys as well, and yeah, MEP and RE7 were like staples of vault curation, and the space just changed so much right now. Outside of these, it's just other themes.
Any other ones on your side, Onur?
I think we mentioned the main ones. I think on the builder side, there's always like bright, and there's always like plenty of opportunity. And even at Breakpoint, which was just the most recent one that I've been to, people were very excited to build like more fun financial experiences. Although I think we captured some of it this cycle already, I think we will continue to see mobile being adopted in crypto as a winner. I think this started definitely mid 2024 already, but I think mobile will continue to be a winner. Just like, not necessarily just a medium, but mobile representative for simplified, more convenient, more fun experiences. At least on the retail side. I think on the institutional side, it's less of a concern. Bullish builders, bullish like DeFi in general. Bearish forced token launches for when it doesn't have to be. Yeah, I think everything we discussed.
Yeah, I think crypto mobile is going to be a leading theme for 2026, and we should definitely dive deeper into that in next week's edition, where we will pivot from 2025 review into our 2026 predictions. But yeah, since we are hitting the hour, any last remarks, any last comments you'd like to make?
No, covered a lot of ground.
So yeah, I think overall we can say that this year was quite tough for crypto and for everybody who's having a significant part of their net worth in the industry or is working in the industry, because the price has definitely not reflected the adoption and growth of actual fundamentals. And it's going to be interesting how this will go forward. I could very well imagine a scenario as Santiago from Inversion Cap and Duji in his article have written about, that basically we see adoption grow, we see the fundamentals grow, but somewhat similar to the collapse of the .com bubble in the early 2000s, we see prices decline for a while.
There's one thing I learned.
That is that this time we have not even really seen a speculative bubble in crypto earlier this year or end of last year. We've had a little bit of upwards price action following the election of Donald Trump, but that's pretty much been it. There was no large-scale retail euphoria at all if you compare it to 2021.
There's one thing I wanted to say here, and it goes back to what I said earlier. Retail has been burnt in this space so many times. How many more times do you think they're going to come back to ape into NFTs and meme coins and stuff? And
I'm
second,
personally very bearish when it comes to like retail coming to crypto for the sake of crypto.
Satoshi himself said that blockchain is mostly a backend technology and should be seen as such. The man, the Lord and Savior himself said that. How exciting can you make backend tech that just wants to redo money? In complete
Yeah.
honesty, at one point, there's this idea that, and it comes from the fact that the space is very US minded, where if a stock or a company doesn't grow at unsustainable rates year after year after year, then somehow it's bearish. And there's one more thing I wanted to say: the overall economy is in a bad spot. The dollar has been printed to levels that we can't even understand anymore. The US is trying everything it can to debase the dollar via stablecoins, which are now the third highest holders of US dollars of T-bills. There are very little places where you can move with that because most of the world's debt is denominated in the US dollar. The vast majority of growth for the US economy is just a couple of AI companies circle jerking the same $500 billion between them. There is very little place for money to go into. And in crypto, we seem to not understand this. We're not insulated from the overall economy. We're not insulated from the overall trends that happen. The dollar is in an increasingly bad spot. The Japan carry trade, which was a significant chunk of the volume going into the US dollar for the past 15 days, is now all but over. The world is shifting a lot and it's changing a lot. And if you're just looking at how much dollars Bitcoin is worth, nothing else, then you're gonna be very sad for a while, and you're gonna say that you're gonna have the impression we're in a perpetual bear market. I don't think it's that simple and that straightforward. But at its core, why I'm bullish about the space, it's particularly about DeFi, is that you can do stuff in DeFi that you can't do in TradFi. You can execute faster, and you don't need 100,000 licenses or to have minimum $1 billion of capital to be able to play with these. And more funds will come in, so volume-wise, the space will be fine. And just to finish, if we get $1,000 Bitcoin in 6 months, that will not be based on anything that will be, as you said, sustainable. So if you want sustainability, this is what it looks like: slow, gruel, boring, slight line go up. If you want exciting bull market, you take it and then you pay for a prolonged bear market after. So which one is it? Do you want the stability, or do you want the pump up and we're all happy and retail comes in and your taxi driver tells you about his Bitcoin mining rig? Because you can't have both. Not anymore.
I saw a tweet the other day which reminds me of what you just said, Vlad, which was something along the lines of, after the dot-com bubble, there was a very, very painful and slow growth trajectory to recovery.
That is Santi's tweet.
Yeah.
It took like what, like 20 years or something?
No, it took until like 2011, so 10-ish years, and then then it was only way up.
Yeah, so I fully agree with you. I think at least like that's what I want. I would want a slow, sustainable path to recovery. The problem I do see realistically is, and this is especially retail in crypto at its heart is just gambling. It's just buying a lottery ticket. Yeah, exactly. This is what I was referring to. So, like from 2000 to 2020, I mean, this is the 20 years I spoke about, but like it reached in 15 years, I think it broke even. Could see something like that for crypto as well, although probably always going to have the microcycles in some weird niche. And by the way, like, yes, obviously, like all meme coins are down 90% now, but meme coins late 2024 and even early 2025, before Trump launched Trump, we're doing extremely well. Like, I was very deep in the trenches, and everyone I engaged with was in huge profits and like was doing very well. Now, obviously, most of these people round tripped. But I think like it's easy to argue in hindsight when everything is down 95%. Oh, like it was horrible. I mean, I think it was one of the venues for retail to actually make money, and I think some people did so.
I think the percentage distribution of people who made money in meme coins looks even worse than the 2017 ICO season. It looks worse than the 2021 alt season. Looks worse than DeFi. It's probably somewhere in
That's not a fair comparison. You have to compare it to 2025 whatever, right? Because DeFi everything was doing well
compared to the other stuff you could have done in 2025. It doesn't look much better.
Like that I don't agree with. Like that's the part I don't agree with.
I'm with you. All the normies who are in stocks and not in crypto have outperformed us.
But stocks is something else again. I'm talking about like crypto.
If you look just inside crypto, then everybody has lost money.
I think the only fair comparison is for meme coins is what else was there to do in crypto in 2024, 2025?
Exactly. The same with restaking. The restaking was big in 23 because there was nothing else to do. So it just came in as a narrative. Can I show my screen for 1 second, Max? Because I want to drive home this point. I don't want it to feel like we're ganging up. This is the only chart I look at. Bitcoin long term.
Opinions I share here, I don't really hold as my own. I'm just playing devil's advocate.
Okay, well, let me talk.
Podcast is just based on rage baiting.
A lot of the cool fundamental tech stuff that we have in blockchain, the fork words, everything happened here in this boring ass part. Yeah, boring, slow, whatever. This is retail. This is the 2017 peak. This was retail. This was ICOs, scams, whatever. Not sustainable. It went down as it should. This was grueling. This is kind of where it started getting better. This was COVID. This was COVID. This was grueling. This was fun, but the problem is it was unsustainable. Just like Onur said, DeFi in 2021 was unsustainable. It was just incentives. It was just Ponzi schemes. This part was awful. Oh, and it was also only retail. This leg up was just NFTs. This leg up was monkey JPEGs. Okay, far from any mature, sustainable yada yada that we want to see. This was also grueling until we got back to here, until it stabilized around 30K. And this leg up was very fun, and it felt organic, and it felt accurately priced. And where we are now kind of feels accurately priced. So as I zoom out and I look, I'm sorry, the idea that we either keep these legs up, that they infinitely grow, and if anything other than that happens, it's a bear market. I just don't agree. It's a lot of noise. And look at where we are, and look at where we were before. And I don't know, we do the weekly, and it's going to look, we're fine. Does this look like a bear market to you? Honestly.
No, I mean, I agree with that, but I would view Bitcoin from a very different lens than I would even view ETH and Solana, and even more so from a different lens than I view most altcoins, and even more so from a different lens than I would view meme coins.
It still dominates the space. And it still dominates the space, and it still gives the sentiment for everything, for DeFi, for meme coins, for everything.
Of course, it correlates, but I mean, all BTC charts have been mostly down only. If you look at BTCD, it is still hovering in the upper 50s or like lower 60s.
Yeah.
So like there was nothing comparable to the 2021 alt season. And I think sentiment very much reflects that.
Yeah. There's no more retail in any of these. There's very little retail. The only retail that we have is the DeFi retail, which is actually smart guys, which I like it.
Last people standing.
Last people standing.
A bunch of French dudes stealing money from another.
Yeah.
All right, friends. I think it's time to wrap it up. This was way better than I expected, to be honest. Thanks, everyone.
Thank you very much for having me on, Max. Nice to meet you, Onur.
Likewise. Should speak more often.
Chat soon.
Merry Christmas, guys.
Same to you. Merry Christmas.
Ciao.
Bye.
See you.